The future of tokenized assets in investment portfolios. The world of investing has seen several shifts over the years, from traditional stocks and bonds to real estate, commodities, and more. However, one of the most revolutionary transformations in the investment landscape in recent years has been the rise of tokenized assets. The concept of tokenization refers to the process of converting ownership of real-world assets into digital tokens on a blockchain. These digital tokens represent a fraction of the ownership, and they can be traded, bought, or sold on various blockchain platforms, similar to cryptocurrencies like Bitcoin or Ethereum. Tokenized assets have the potential to disrupt traditional investment portfolios and redefine how investors approach wealth building. As blockchain technology evolves and becomes more integrated into mainstream financial systems, tokenized assets are set to become an integral part of investment portfolios, offering numerous benefits such as increased liquidity, fractional ownership, and broader access to diverse markets. At its core, tokenization involves creating a digital representation of an asset, whether it's a piece of real estate, an art piece, a share of a company, or even commodities like gold or oil. This digital token, stored on a blockchain, acts as proof of ownership. By leveraging the transparency, security, and decentralization of blockchain technology, tokenized assets can facilitate easier and faster transactions. Blockchain's immutable nature ensures that ownership records are permanent and cannot be altered, adding a layer of security that traditional asset management systems lack. These features present a host of opportunities for investors, making tokenized assets an appealing addition to modern investment portfolios. One of the most significant advantages of tokenized assets is increased liquidity. Traditionally, many types of assets, such as real estate or fine art, are illiquid, meaning they cannot easily be converted into cash without a lengthy sales process. For example, if an investor wants to sell a property, it could take months or even years to find a buyer, complete the paperwork, and finalize the deal. Tokenization allows for the fractionalization of these assets, meaning that instead of buying an entire property or artwork, an investor can purchase a fraction of the asset in the form of digital tokens. This makes it easier for investors to buy and sell fractions of high-value assets, dramatically improving liquidity. Through tokenized assets, real estate, art, and even private equity shares can be more readily traded on secondary markets, offering investors the opportunity to exit their investments more quickly and efficiently. Another compelling feature of tokenized assets is fractional ownership. In traditional investment markets, certain assets may be out of reach for average investors due to their high value. For example, purchasing an entire apartment building or a famous painting can require significant capital investment. Tokenization breaks down these high-value assets into smaller, tradable units, allowing a broader pool of investors to participate in the market. Fractional ownership democratizes access to high-value assets, enabling people with limited capital to diversify their investment portfolios by holding a small portion of multiple high-value assets. For instance, an investor could own a fraction of a luxury property in New York, a rare piece of art, and shares in a private startup, all without needing millions of dollars. This fractional ownership model opens up investment opportunities to individuals who previously would not have had the financial means to participate in these markets. Tokenization also enhances transparency and reduces the complexity of managing assets in investment portfolios. Blockchain's decentralized nature means that all transactions involving tokenized assets are recorded on an immutable ledger that is publicly accessible. This level of transparency ensures that investors can track the ownership history, transaction details, and provenance of the asset in real time. For example, in the case of tokenized art, investors can trace the artwork's history, confirming its authenticity and ownership status at any point in time. In traditional markets, this process of verification can be costly and time-consuming, but blockchain technology simplifies it, providing an added layer of trust. Furthermore, because blockchain transactions are automated through smart contracts, the process of transferring tokenized assets between parties is faster and more efficient than traditional methods, which often require paperwork, third-party intermediaries, and manual processes. Additionally, tokenized assets provide investors with greater access to global markets. Traditional financial systems often involve barriers such as geographical limitations, currency exchange issues, and complex regulations, making it difficult for investors to access certain markets. Blockchain, however, enables tokenized assets to be traded across borders seamlessly. A tokenized piece of real estate in London can be bought and sold by an investor in Singapore without the need for currency conversions, cross-border regulations, or lengthy approval processes. This opens up investment opportunities in markets that were previously inaccessible, further diversifying an investor's portfolio and providing access to global opportunities. The potential for tokenized assets to enhance the diversification of investment portfolios is also a crucial benefit. Traditional portfolios often rely on a mix of stocks, bonds, and other conventional assets, but tokenization allows investors to tap into entirely new asset classes. Real estate, art, intellectual property rights, precious metals, and even sports teams can all be tokenized and added to an investment portfolio. The ability to invest in a variety of asset classes is essential for portfolio diversification, as it reduces risk by spreading investments across different sectors and industries. Tokenized assets allow investors to easily adjust their portfolios to include a mix of traditional and non-traditional investments, increasing exposure to different markets and potentially enhancing returns. Tokenization also brings efficiency and cost reduction to asset management. In traditional markets, managing assets and transactions typically involves multiple intermediaries, such as brokers, custodians, and lawyers, each of whom charges fees for their services. These fees can eat into an investor's returns, especially when dealing with illiquid or high-value assets. Tokenized assets, however, are often traded directly between parties through smart contracts, eliminating the need for intermediaries. Smart contracts automatically enforce the terms of the transaction, ensuring that assets are transferred securely and efficiently. This reduction in intermediaries can lower transaction costs and make the entire process more cost-effective for investors. Despite the many benefits, the adoption of tokenized assets in investment portfolios is still in its early stages, and there are challenges that need to be addressed for this technology to reach its full potential. One of the primary concerns is regulatory uncertainty. Governments and financial regulators around the world are still grappling with how to classify and regulate tokenized assets. While blockchain technology has proven its value in providing transparency and security, the legal status of tokenized assets remains unclear in many jurisdictions. The lack of clear regulations could create uncertainty for investors, especially if there are concerns about the taxation, legal recognition, or protection of tokenized assets. Furthermore, the volatility of cryptocurrencies and digital tokens can pose risks to investors in tokenized assets. While the value of tokenized real estate or art might not fluctuate as dramatically as that of cryptocurrencies, the underlying blockchain infrastructure can still be subject to price volatility. Investors must consider the risks associated with the volatility of the underlying digital tokens, especially if they are trading on highly speculative or new platforms. For tokenized assets to gain broader acceptance, there will need to be more stability in the blockchain and token markets, as well as stronger safeguards against market manipulation. Another challenge lies in the technical aspects of tokenization. Tokenizing an asset requires a deep understanding of blockchain technology, smart contracts, and the mechanics of digital tokens. While blockchain platforms are improving in terms of user-friendliness, the process of tokenization may still be complex for individuals who are unfamiliar with the technology. Additionally, tokenizing certain assets, such as real estate or intellectual property, requires compliance with legal frameworks and a clear process for verifying ownership and transferring rights. Ensuring that tokenization platforms comply with these regulations and offer secure solutions for asset tokenization will be crucial for widespread adoption. Despite these challenges, the future of tokenized assets in investment portfolios remains promising. As blockchain technology matures and regulatory clarity improves, tokenized assets are likely to become more mainstream, with institutional investors and individuals alike incorporating them into their portfolios. The potential for increased liquidity, fractional ownership, diversification, and access to global markets is undeniable. In addition, the ability to automate and streamline asset management through smart contracts will continue to drive the efficiency and cost savings that tokenized assets offer. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go.